Preservation of capital is so important. You don't want to make bad investment decisions where your net worth is actually going backwards. And so you've got to really be patient. You've got to think about preservation of capital just as much as you're thinking about return on investment.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Andrew Reichert. Andrew is the CEO and founder of Birgo, a real estate firm in Pittsburgh, and also a serial entrepreneur that has started over 4 companies and involved with several other startups. Birgo has over $312 million in assets under management and also oversees 3,400 multifamily units. Birgo is completely vertically integrated and has over 90 employees. And also, one of the things you'll find interesting about Andrew is his deep passion for nonprofit and the spirit of helping others with financial literacy and also his local charitable organizations. So welcome to the show, Andrew.
Dave, thanks so much for having me on the show. Excited to be here.
Yeah, absolutely. Always great to connect, Andrew. I really support, your mission, what you're doing on the nonprofit side. And the other aspect of really, helping others, not only with financial literacy, helping your investors, right, in terms of their mission and that, impact that you are creating. So tell us a little bit about, how things started for you. How did you get into real estate? How did you become an entrepreneur? What was there a certain moment that, was your light bulb moment that got you going in this direction?
Yeah, those are great questions, and happy to share a little bit of my story. So I grew up in a family with very little financial means. We grew up just kind of making ends meet day in and day out. And unfortunately, I had a bit of a rebellious childhood that culminated in me actually getting expelled from high school. And so I tell people I get my starts in entrepreneurship from doing things that I probably shouldn't have been doing, selling drugs and just kind of doing whatever I could in high school. And so, that was really my breaking point. I said, hey, I've got to make a decision to get my life together. And specifically this financial piece became something interesting and impactful as I actually went to college, got accepted to college even after getting expelled from high school. And I read this book called Rich Dad, Poor Dad. And I just started to understand the mentality of wealth and the different quadrants that he talks about in that book of being an employee versus being self-employed versus being a business owner versus being an investor. And that actually was my exact path. Those are the 4 sort of steps that I ended up taking. And that was my launching pad into doing what I'm doing today.
Yeah, awesome. You took the purple pill like so many others out there. I found that so fascinating as well at the time when I read it, actually just when it came out, in the cash flow quadrant, I found so powerful, right? To just really simplify this concept that was explained in a way that no one has ever explained it before. And really that should be taught in high school, around financial literacy, how is the game really played? One of the things that I found, challenging, however, was, you would read those books. And so you kind of understand that concept, but how do you really put it into action? There was no blueprint per se. So did you have some type of path once you got that inspiration? Was there something that led you down a particular path?
Yeah, it's a great question. So it was really a crazy time because I read that book, but I had no money, no credit, no experience. I mean, I had nothing to offer. So I started reading all these books on investing in real estate, and specifically investing in real estate with no money down. And so I graduated from college. It's 2007. So this is before the financial crash of '08 and '09. And the banks are just doing crazy stuff. And so I actually end up buying a duplex with no money, no credit, no experience. And I walk away from closing with a check for 20 grand. So it just goes to show you the banks really, we're doing things they shouldn't have been doing. I had no business loaning to me on a duplex enough money that not only did I bring no money to the table, I got a check for 20 grand at closing. So I took that check for 20 grand and, I was reading books about a short sale. So the first one I bought with no money down. The second thing I did is I bought a short sale. So I bought a property for right about 20 grand and, paid all cash. And this was a property that was, worth about 100,000. So it was really just self-educating. And then to your point, I kind of learned by doing. I mean, it's really one of those things where you have to jump in and do the thing to really understand it.
Yeah, that's the full life cycle of learning, right? It's learn, do, teach, right? Which is the key to do it. But I think so many of us don't actually take action. They might read some of these concepts or be exposed to the concepts, but they don't actually take the action. And it's when you can take that action that really propels you forward, and not being afraid to make mistakes, because we all make mistakes, but can you learn from those mistakes and then grow from them?
Totally. And I made my share of mistakes and, have learned. I love, there's this Nelson Mandela quote. He says, I never lose. I either win or I learn. And that was the case with my early investing career. That was certainly the case with, my early life in general, dealing with adversity from being expelled and, making bad decisions along the way. I just viewed them as learning opportunities and tried to, do things a little bit differently the next go around.
Yeah, makes sense. So, and then was that your growth path really, from doing, fix and flips and just, doing active type investing to move into multifamily at some point? When did you transition into multifamily and syndications and start Birgo?
Yeah. So I had a great job after college and I was investing in real estate passively on the side. So working for a large regional bank, but I was taking my discretionary income and investing it all in real estate at that point. So I got to the point where I had 20 units that I was managing on the side, managing on my own. And I just kind of knew something had to give. Again, I had even a different startup at that point. So I had a startup focused on financial literacy. I had this 20 unit portfolio that I was managing and a full-time job. And so I ended up resigning from PNC at that point and started what is now Birgo. And what I really wanted to do is take what I had been doing with my 20 units and bring that out to the masses. So I just couldn't believe the economics of, in Pittsburgh, I could buy a single family home for $100,000 and I could rent it out for $1,200 a month and the mortgage was only $600 a month. And so the economics just made so much sense from a cash flow and even an appreciation standpoint. I said, hey, can I scale this? Can I do this to the masses? So in 2015, decided to launch a proof of concept fund. Our goal was to raise $10 million just to prove this out. We ended up raising 17 million, deployed that all into multifamily in sort of Pittsburgh area, about a 15-mile radius to downtown. We wanted to be able to drive to those assets. And so purchased about 800 units and, multifamily. And that was really what kind of got us going in the path we're in today.
Wow, that's excellent. And what markets are you specifically focused on?
The thing we really look for is markets that are kind of slow and steady up and to the right. We're not sort of investing in the really crowded, sexy areas right now, like the Sun Belt and the coastal cities where everybody else is investing. We like Pittsburgh, but we also just like markets that are like Pittsburgh. So markets that are undergirded by a good economy. You've got the meds and the eds that we like to say, really strong universities, strong healthcare systems, just strong economies undergirding them. So for us, that's Pittsburgh, Cincinnati, Cleveland, Buffalo, a little bit in Morgantown, West Virginia. Those are really the markets we're investing in today.
Hmm. Interesting. And how is population growth in some of those markets? Is it just kind of slow and steady, or has it, curtailed, or what are you seeing?
Population growth is pretty flat in most of the markets where we invest, and that's fine. If you look at how we create value, we create it three ways. One is just the cash flow to our properties, average rents. I gave that example earlier of what do the economics look like. Average rents across our portfolio are around $800 a month. But for us, that's often buying a property that's currently rented around $500 or $600 a month and increasing it to market. So, $750 for a one bedroom, $950 for a two bedroom, that kind of market. So that generates cash flow. Paying down the mortgage obviously generates IRR for our investors, internal rate of return. And then the appreciation that we create is actually not because the market is appreciating or because population is going into the market. We create appreciation just by increasing net operating income, which increases the value of the assets. So, we like to invest in markets that are just stable from a population and a growth perspective, because, if just to contrast that to another market that's close to us, Columbus is a booming market, which is in between two of our markets. It's like halfway in between Pittsburgh and Cincinnati, but we're not investing there because we think that it's a little overheated. And, we think that because of all the population growth, there's a lot of outside money that's flowing into that market. And we don't buy the valuations there.
Yeah, no, I can see that slow and steady is good in the game of investing for sure. I think we're all always enticed by, shiny objects and things that can be sexy on the outside, but it's really all about, just that consistent growth, right? And and putting it into a system, right, that can kind of grow over time. How about from a debt perspective? Right. It's been kind of a challenging market. So, how are you guys, looking at underwriting these days? What should investors be aware of when they're looking at potential opportunities?
Yeah, great question. So obviously interest rates have gone up. We used to be borrowing at 4%. Today we're borrowing at 7%. And that definitely has an impact on underwriting. There's a couple of things we're doing. One is, whenever we can, we're assuming the existing debt when we buy an asset. So, sellers who have debt at 4% that's assumable, that's an asset now. That they have existing debt that we can assume, and that actually helps to make that a really attractive acquisition opportunity for us. The agency lenders like Fannie and Freddie will typically let you assume the debt. So, we tend to be looking to buy assets that have good existing debt that we can assume. If we're putting new debt on, that just works its way into the underwriting and typically just makes the deals more challenging. Where we used to do a good bit of the deals that we would underwrite, we're underwriting a lot of deals and just passing on them right now. But that's okay, because we're still seeing a lot of deals and we're still seeing good deals to be done. I mean, there's deals that can be done in any market. And what we're seeing right now is they tend to be a little bit more distressed deals that we're buying. Maybe the seller got themselves into a little bit of trouble on the cash flow of the property or on the existing debt of the property. And so it gives us an opportunity to bail them out and create a good investment opportunity for our investors. So those are the kinds of deals that we're doing now, but certainly underwriting is more challenging in this market.
So are you in B class? Are you doing any C class, or is it mostly B?
We're squarely right in B. Yeah, we don't really touch A or C. Yeah, we've got some what I would call maybe B minus or B plus, depending on the asset. We do have some assets that have some kind of light amenities to them. But if you just look at our average rents, again, $800 across our portfolio, it's sort of the working class individual is our typical tenant. They tend to live paycheck to paycheck or a little bit above that. And, tend to be a pretty sticky tenant base, folks who stick around in a unit for a while.
What do you think investors should be considering in 2024 when it comes to multifamily real estate?
It's a good question. I think there's a couple things to consider. One is, what are interest rates going to do? So, I think the Fed has maybe been signaling some cuts. I think rate cuts would really provide some relief and make some of that underwriting we were just talking about attractive. So I think if I'm an investor, not that you have to be an economist, but I would definitely be paying attention to and thinking about interest rates. I would say I think there are a lot of operators, particularly multifamily operators, that like syndicators, for example, who have gotten themselves into a little bit of trouble, just kind of gotten out over their skis. So, I'm at least in our firm, we're taking a pretty conservative approach to underwriting and to deals in general and to reserving capital and making sure that we're setting ourselves up for a strong future ahead. And so I would say, if you're investing in multifamily, make sure you're taking the long-term approach. Don't be, too short-term focused. It's a bit of a marathon, not a sprint. Make sure you're sticking with the fundamentals, underwriting deals well and not getting out over your skis.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah. And what do you guys typically look at for LTV?
Yeah. In the early days, we were able to borrow in 75%, 80% loan to value. Those have just come down for two reasons. One, we're often assuming the existing debt right now if we can. So the existing debt is typically not as high. We're assuming debt that's 60% loan to value or somewhere thereabouts. And then lenders, because of the higher interest rate right now, are often lending at lower loan to value rates, ratios, typically in the 70 to 75% is kind of what we're seeing for new debt.
Yeah, that's pretty interesting. I think a lot of operators have different takes on, LTV kind of perspective. And of course, it all depends on market, asset type, business model. There's so many variabilities to it. But great points, in terms of things I think people should be thinking about. We've certainly been, very cautious in this market. Even a lot of the distressed opportunities that have been coming across our desk, we still think they're overvalued, so they really need to have super strong fundamentals, across the board. But I think, being exclusive and being very selective in opportunities is going to be key, and just really defining what that buy box looks for you. I think that can be one of the things that can help investors so much, right? Is just getting real clarity on what your strike zone looks like for opportunities, and then constantly developing that, and then your due diligence, process, right? So that you can look at more opportunities and figure out which ones kind of fit into yours.
Well, that's exactly right. And everybody has a different, risk return spectrum and where they are on that. And I think, to your point, it's understanding your buy box. It's really hard to be educated about everything, to know enough about real estate and private credit and self-storage, whatever it might be. And even within real estate, there's so many asset classes. So I think it's really understanding what is it that you can know that you can invest in well. And if you can't have sort of that target niche, then, hiring a professional that can sort of do some of that for you, I think, is the next best thing.
Yeah, 100%, right? Because that's where, this is all about leverage. And I think, people kind of always talk about leverage, or, Kiyosaki terms, right? It's OPM, other people's money, and trying to scale and things like that. But we often overlook that in passive syndications, you get leverage with people, right? So like engaging with a team like Andrew that has almost 100 employees, right? And a super strong track record, you're able to completely get access to that team of, world-class property management, acquisitions, all of that experience to be able to be making the right decisions. And I think, that's why we talk a lot about just investing in, the jockey, not the horse, right? It's all about the people, behind the thing. So any other kind of, thoughts or, perspective you would say on that?
Yeah, I mean, I think specific to that, you're 100% right. And we talked a little bit earlier about, some of the mistakes we made in the early days and how we've learned from them. I think the reality is for folks who often try to go it alone, they're often just making the same mistakes that we made and that we learned from, and that we built systems and processes around, to not make those mistakes over the past 10 years. So I do think, there's multiple paths to make money. There's multiple paths to, retain and continue to build wealth. I think working with folks who sort of know the specific area in which you're looking to invest can be a great way to do that.
Yeah. Yeah, for sure. Yeah, when I started originally getting into real estate myself and looking at, single family rentals and duplexes and trying to run all the math, I mean, I actually, as gung ho as I was to get into the asset class, I found it very risky because I was making all these assumptions based on what I knew, which wasn't really much, and you're competing against people in any market who are doing it all day long, who've been doing it for decades, right? And have inside information to really know, how a deal is right. So I think a lot of people get bruised up, or maybe they're lucky, right? And you have some good ones, on the single family side, but that's why most people will scale up, in passive, type syndications, right? So the key is focusing on what you do best and, kind of what your purpose is, and then trying to get leverage to grow your portfolio with the experts.
Yeah, totally agree.
So Andrew, tell us a little bit about your nonprofit and, how is that kind of set up? What's your involvement? What's your mission there?
Yeah, so I'll give you a little bit of the history there. So when I first got into real estate, again, I told the story, it was really about real estate as an investment, but I didn't realize that real estate is so much more than an investment. It's the roof that you put over somebody's head. It's the places where people work. It's the fabrics of our community. And as I started to learn that, it actually became really exciting, but also a bit intimidating. And one of the things that I realized is, on the for-profit side of our business, the transaction sort of needs to be, we put a roof over your head, you pay the rent, you don't pay the rent, it leads to eviction. And that was just really hard for me. I had to physically be there when we were doing lockouts of our residents that didn't pay the rent, and watching them cry and, taking them back to go get their stuff that was left in the unit. It is just a very emotionally draining, difficult process. So I just asked myself the question, what can we do to extend grace to people who, maybe fell on some hard times and, don't have the money to pay their rent right now? How can we extend grace while still holding them accountable? Because we certainly don't want to be taken advantage of. And we also, this was my own portfolio, but as we've grown, we have to be stewards of our investor capital. And so we have to do right by our investors too. So yeah, a few years into having the real estate business, started a nonprofit. The goal was, hey, if we could help residents understand the parameters of personal finance, so really help with financial literacy, could we get them back, paying the rent, keep them in their units, and actually help them long term? And so that was the nonprofit that we started, hired an executive director, actually ran a bunch of our residents through a couple of cohorts of financial education, had some great results, and had some folks who were delinquent and ended up becoming performing tenants and staying in their units. And the transaction was basically, hey, resident, if you're a month behind on your rent, we will withhold the eviction process as long as you go through these education classes. And in fact, we'll pay you $100 per month for every month you go through these education classes. And, that will help you get caught up as long as you can kind of continue on with the payments. And so by and large, it worked. We had some really great results. Unfortunately, when COVID happened, we weren't able to do the in-person cohorts. And frankly, virtual cohorts for that particular tenant base just weren't really an option. So we did end up shutting that down when COVID happened. We're currently engaged in conversations around what that could look like to launch that again and scale it up. But it produced great results in the time that we were doing that.
Yeah, love it. Really just trying to help the communities, help the people. I mean, it's a whole win-win-win situation, 360 degrees. Very, very nice. You and I have talked a lot about personal productivity and biohacking and all kinds of things. Have there been a couple of, key things for you that have, helped keep your head afloat and charging forward every day?
Yeah, it's a great question. It's probably one of my favorite topics in the world. So I could talk about this for a long time. But, one of the things that's interesting about my journey is I actually got diagnosed with cancer. And this is the 10-year anniversary since I was diagnosed with cancer. And so I was 1 year into marriage with my wife, less than a year. And I'm told that I might not live. And even if I do live, we may never have children. And so if you could just imagine being 1 year into marriage and watching my wife's eyes, tear up as she's getting that news, it was really impactful. And so over the past decade, I've just put myself on this journey of learning everything that I can about personal development and health and fitness. And, thank God I've been cancer-free now for that entire time. And that particular cancer is long gone, and I won't have to deal with that again. But now I'm in more of the prevention phase. It's, hey, how can I make sure that this never happens to me? And also just caring about my wife. And as a miracle, we have 3 little girls now. So it's thinking about them and how can I make sure that, again, they don't make the mistakes that I made early in my life that may have led to, maybe not the best health and fitness habits. So I've actually created a little bit of like an operating system. So we run our business on what's called the Entrepreneurial Operating System, or EOS. And so I've created this operating system for kind of personal development that we call the Rhino Operating System, or ROS. We're like obsessed with the Rhino here. And the reason I really love the Rhino is because it's a picture of resilience. It charges ahead. It's got this really thick skin. It's like hunted and it's actually been endangered, but yet now population of rhinos are actually growing. It's like the rhino's not going anywhere because it's so resilient. And so the system that we call a Rhino Operating System has 5 components. It starts with the who, really understanding your unique DNA, and then why, understanding your purpose, and then what. So taking your why and your who and understanding what should you actually be doing, sort of the combination of your passion, your proficiency, and your preparation. And then from there, the how, which is the actual executing on that. And then the when, which is really all about daily rhythms of execution. So I've got tons of stuff I do in every single one of those 5 components. I could talk about it all day. If I had to pick one thing, it's actually in the when component, which is my morning routine. My morning routine is my anchor keystone habit. When I do it, and it has a bunch of components in my morning routine, takes me about 90 minutes. When I do it, I'm on track. I'm feeling great. When I don't do it, I feel like I'm drifting and totally off track.
Well, first of all, congratulations on remission and creating a family. That's really amazing, Andrew. And just, love the framework, right? I think all of these, thinking things, and this is kind of why we created the holistic wealth strategy as well, is to, just help people frame things up so you can think through it in kind of a pragmatic way, and really, set your compass the right way, to make a difference. But if you could say, could you give us one example of what would be, the top thing in your ROS? Morning routine is one, but what else would be something that's, really core to that being successful?
Yeah, I would probably pick a couple things. Okay, if I had to pick one, I would pick in the why component, having a life plan. So a life plan is where you begin with the end in mind. So you say, when I'm no longer here, how do I want to be remembered? And so it's a bit of like a morbid thing, but you say, what do I want to be said about me at my funeral? And I feel like so few people actually ask that question. What do I want to be said about me when I'm no longer here? And from there, I come up with my life accounts. So I think for me, it's spiritual, physical, mental, emotional, parental, marital, social, financial, vocation, avocation. So I have these 10 life accounts. And in each of those, I set an envisioned future. What should this look like 10 years from now? And I set my purpose in each of those. And then I work backwards from there. And so that is like such a key, important piece of understanding why are we actually doing what we're doing. So I feel like so few people think about that, and they just go through these daily motions doing their job, and they haven't actually connected it to their broader purpose.
Yeah, that is so powerful. Understanding why just allows you to break down doors. It allows you to get through the challenging times and life has, and really live, so much more of an intentional life. So really love that you have that focus there. So tell us about your morning routine. What does it look like?
Yeah. Well, I got to tell you, I can't take credit for it. A guy by the name of Hal Elrod wrote a book called Miracle Morning. I actually just met Hal last month and got to shake his hand and tell him like, hey, when I had cancer, I read your book. In fact, right when I got diagnosed, I read this book, Miracle Morning, and it changed my life. And so I got to shake his hand and thank him for that. But there's this acronym that he talks about in that book, and this is the exact thing that I do today. And it spells out SAVERS. He calls them his lifesavers. And he actually had been in terminally ill situation himself. It was in a terrible car accident, actually had died for 6 minutes, had to be resuscitated back to life. And this was his morning routine. So having gone through a little bit of adversity myself, I consider it a privilege to have adopted the same routine. But S is for silence. For me, it's silence and prayer. I'm a person of faith, so I spend some time in the morning just being quiet and praying. A is for affirmations. Affirmations get a bad rap. They tend to be thought of as like woo-woo kind of stuff, but it's really just affirming what is already true about myself and about sort of where I'm headed. V is visualization. So I actually visualize my day and visualize myself in my meetings and the things that I'm doing that day going well. E is for exercise. I've just got to exercise every single day. I love it. I love the feeling after I exercise. R is reading. So really working on growing my knowledge base, but also just reading things that are life-giving to me. And then the last S is scribing, which is really just journaling. And, I think the acronym needed an S there instead of a J, but I do journaling pretty much every day if I can.
Yeah. Awesome. Love it. So if you could give just one piece of advice to the audience about how they could accelerate their wealth trajectory, what would it be?
One piece of advice to accelerate wealth trajectory. Well, this may be a little bit counterintuitive, but I think the piece of advice that I would point to is just remembering to be patient and that it's a marathon and not a sprint. And honestly, just to ignore anything that looks like a get rich quick scheme. The thing that I'm passionate about is actually getting rich slow. It's really a game where preservation of capital is so important. You don't want to make bad investment decisions where your net worth is actually going backwards. And so you've got to really be patient. You've got to think about preservation of capital just as much as you're thinking about return on investment, and just invest from what you feel comfortable with and confident in, as opposed to getting out over your skis and trying to swing for the fences.
Sage advice. Andrew, it's been such a pleasure having you on the show. Really appreciate all of your wisdom and insights that you've been able to share. If people want to connect with you or learn more about what you're doing at Birgo, what's the best place for them to connect?
Yeah, thanks, Dave. I'm pretty active on LinkedIn. So Andrew Reichert on LinkedIn. Our website is birgo.com, birgo.com. We do have a podcast as well where we talk about investing called the Real Returns Podcast. And you can find Birgo Capital on social media, Instagram, Facebook, LinkedIn, kind of all over. So feel free to shoot us a note if we can be of any support.
Awesome. Thanks so much for coming on, Andrew.
Hey, thanks for having me on the show, Dave. It was a lot of fun.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.